Hello, my friends. Brett Pattison coming at you from the financial capital of the West Salt Lake City, Utah. Joined by the big fella, the chairman.
Brett, how you doing, buddy?
Oh, living the dream.
Good.
Except I'm kind of depressed because
Why?
I was told a recession's coming.
Hmm.
But we're going to talk about that here in a minute. Do I look depressed? I don't look depressed.
Brett never looks depressed.
All right, market update. The S&P 500 as of today, what's today? The 29th of March, Tuesday. The S&P 500 is down 2.85% on the year. The NASDAQ's down 6.7% on the year. That's significantly above where it was the last podcast we did.
Yeah.
In fact, the NASDAQ is up 17.3% from its lows, and the S&P 500 is up 12% off of its lows. That's a pretty good rally.
Who would have predicted that just a couple? When did we do our last podcast? Like
2 weeks ago.
2 weeks ago.
Boom.
Who would have predicted that the market's going to be up that strong in just the last?
No one
That's why you
knows.
stay invested.
It's also why you do something else. We have a couple friends that like an analogy that's called gas in the gas tank.
Gas in the tank.
Yeah.
Yeah.
Jed and Brian.
Yeah.
They talk about this all the time. And so what do they mean by that? Well, if you're disciplined and contributing on a monthly basis or quarterly basis, right, whenever you can, money to your investment accounts, then you always have gas available in your tank for us to buy at the right time.
Right.
We put a lot of client money to work, not right at the lows, although I'm sure we did in some accounts time the lows, but in most client accounts, the S&P's down 5%, buy. 10%, buy. NASDAQ's down 20%, buy. Now we're down 2.85 and 6.7%.
It gives us the opportunity to put money to work when there's some attractive opportunities, and it's a great idea. And I think all of our clients should be contributing on a regular basis into their accounts, and that'll give us an opportunity to buy when there's good opportunities. Otherwise, one of the problems that when we're fully invested and we have these opportunities, it's not a problem, but we can't take advantage as easily of market corrections.
As easily. We've done a lot of changes to the portfolios and selling some stocks to buy some others that were just incredible bargains. But it's a little bit more difficult, and we don't love selling, stocks or reducing allocations in stocks we love to buy other stocks we love. We just would rather use the gas in the gas tank to buy the stocks we love. Right?
Mm-hmm.
So, incredible opportunity last month. I don't know if it's going to continue. I don't know if we revisit the lows. Wouldn't be surprised, but also wouldn't be surprised if we just hang out from here and grind higher, grind lower. I have no idea.
Yeah, we don't know. Yeah, just 2 weeks ago, we've seen a pretty good rebound, and of course we didn't predict that. And the next 2 weeks, I'm not sure what's going to happen.
Yep.
Not too worried about it.
But it's been a fun year so far with options, with trading, with buying and setting up the portfolio for the next 2, 3, 4, 5, 10 years. I mean, it's been incredible opportunities.
And I have a different attitude. I've been doing this for 30 plus years. I have a different attitude with market corrections. I like them. I mean, believe it or not. And maybe our clients will get mad at me for saying that, but when we have high valuations, when stock prices are trading above fair value, that's just creates your returns going forward will be less. I would rather have reasonable prices that allows us to put money to work at attractive prices for our clients. Of course, we'd all love, really ideally what you want is you want the stock prices to stay low up until you're ready to retire, and then once you retire, you want this big boom, and that allows you to accumulate more shares when prices are lower during your accumulation phase, and then have higher prices when retired. Of course, that's not realistic, and that's never going to happen exactly, but ideally that's what you want. And so having reasonable valuations on stocks is a good thing in the long run.
Yep. And we talked about having a plan last time and the importance of that, and that fits right in line with what you're saying. A couple things that I want to talk about today, other than just a market update. I want to talk about, I've been told like I said at the outset, that a recession is going to happen.
Mm-hmm.
Okay, so we want to talk about that. And then I want to talk, we get a lot of clients or potential clients that say, hey, I just want a dividend portfolio. Or, hey, I want a value or growth or just straight income. You know, they want those ideas or those types of investments. So I want to nip the bud and talk about growth versus income versus value. And probably most people looking for income, right? So dividends. So let's talk about that as well. Okay. Now, I'm going to take us back, Brian, a couple years to COVID. Okay. And I'll even backtrack a little bit more. Do you know and people listening, do you know someone in life that loves drama? Like they just love craziness. They thrive on it. They thrive on worrying about something.
We all know somebody like that.
Oh man, we do. We do. And so the reason and think about as you're listening to this, think about those people that love drama in their lives and they call you on the phone and there's drama. Okay? But there's a large segment of our population that the news media preys on that are drama lovers, I'm going to call them. Okay? So 2 years ago it was COVID, right? COVID, and it was serious, right? Don't take it lightly, but it caused the drama lovers, they thrive on that. And then COVID all of a sudden disappears because there's a war to worry about. And now the war is kind of going away, and guess what's replacing that? The coming recession.
Right.
The economic collapse that's coming. So if it's not one thing, it's another. Okay? And to top it off, Brian, before we talk about a recession, I was watching the 2 and 10 today. The 2-year and the 10-year. And it inverted.
So explain what the 2 and 10 is. I know what it is.
Explain it to the people.
Brett's talking about the 2-year treasury note or bond and the 10-year treasury bond and the yields on those bonds. So what rate of interest those bonds will pay you, and that's what we're talking about. The interest rate that the 2-year treasury and the 10-year treasury.
So the 2-year right now, typically the 10-year pays more than the 2-year. Right? And you would think that's the case because it's longer in time and you're assuming more risk by going out. So you should be paid more. Well, right now, the 2-year is now paying more than the 10. So the 2 flipped above the 10. That's called an inverted yield curve. Mm-hmm. And here's the problem, Brian. This is what the drama queens and kings and whatever you are these days, I don't know. This is what's on their mind. Since 1976, there's been 5 inverted yield curves. And guess how many recessions have occurred after those yield curves?
5.
Yes. 5. So what do we do right now, Brian? There's a recession coming.
And we talked about this. There's always a recession coming. There's always a recession coming. So when I hear statistics like this,
which you will hear, if you haven't, folks, if you haven't heard it, you're going to hear it. Inverted yield curve recession's coming.
So we were just talking about this before we started recording. And I said, okay, and how long after this happens does the recession happen?
I love this. 17 months, 9 months, 19 months. Here's my favorite one. 23 months, almost 2 years after the inverted yield curve took place, the recession occurred, and 6 months. Okay. So those are the last 5. So the average is 13 months before recession.
And I keep saying, there's always a recession coming at some point. So we know that's going to happen. And so I'm like, who cares?
That's about the best summary we could.
That's how I feel about it.
Yeah.
We don't. No one likes recessions. I mean, there's economic hardships when we have recession. People lose jobs, their incomes go down. We talked about this last week. There's kind of a reset on prices and things like that. No one likes that, and especially no one likes what happened in the financial crisis. I mean, that was much more than just a recession.
Yeah.
That was almost a depression. I mean, that was the worst economic downturn since the Great Depression. So I'm not making light of that, but recessions are typically happen fairly regularly, and it's part of a normal economic cycles. So that's one thought on it.
So if a inverted yield curve, which did occur today, occurs, it's like I don't know what the best example is. It's like I'm going to use Duke, North Carolina, because they're playing in the Final Four together, right, against each other. It's like a Duke fan saying we're going to beat North Carolina, and then North Carolina wins 5 in a row, and then Duke finally wins, and he says, "See, I told you so." Like, of course they're going to win at some point. Of course there's going to be a recession. Like, it's going to happen. But from a timing indicator, from a, hey, take action on your portfolio.
It comes, by the way, I have Duke and Kansas.
Yeah, your bracket looks solid.
I might have
Yeah.
two of the both teams in the final. So
You win the office pool.
I think I'm winning the office.
Yep, you win. I'm out.
Yeah, so I was in my car today listening to CNBC. I think I was coming into work or something, and talk about recession. I mean, that's all we're listening about.
That is
listening.
it.
Everybody's
Yeah.
talking about potentially a recession coming. And 3 months ago, we weren't even talking about this. We weren't even talking about a recession. And now it's like you said, the drama. And I would blame a lot of the drama on the financial news. I mean, that's what they're all about, is creating drama and fear and excitement.
Yep, we've talked about it.
And that's what
Clicks.
they do,
Yeah.
right? That's just what they do. They're the biggest drama queens in the world, for sure. But I'm kind of scratching my head and saying, where did this come from? And I know where it came from.
Yeah.
Just
High gas prices.
high gas prices and higher interest rates and higher inflation. I remember in 2018, we had that big 20% decline the last 3 months of the year, 3 or 4 months of the year.
Yeah.
Guess what? You know what the conversation was then?
Recession.
The Fed started raising rates, and everybody started freaking about, we're gonna, the Fed's gonna
Economic slowdown.
the Fed is gonna overshoot and cause an economic slowdown. We're gonna have a recession. What is a recession? 2 quarters of consecutive negative GDP growth. Two quarters. That's all
So
it is.
how would that impact an investor's portfolio or future plan?
So how
A
that
recession.
impacts a portfolio, it's just like the farmer that owns a farm. You're probably sick of me mentioning it, but over 10 years he's going to have a couple bad years. Okay, we may have a down year. That's possible, but it doesn't change the long-term strategy. If you're invested in stocks, you should be invested. You should have a time horizon of greater than 3 years or longer. So it shouldn't really impact what you're going to do today or tomorrow. You just stay with it, stick with it.
And we do financial plans for people, Spencer and Matthew here at our firm. And when they tell somebody there's an 85% probability that they can accomplish their goals, which is very, very good, that includes factoring in recessions.
They run this sophisticated software, and they do a Monte Carlo calculation. It runs 1,000 calculations on historical returns, the best, the worst, bad years, multiple bad years, and good years, and all kinds of scenarios. And if you can get 80%, probability on your portfolio, and that's what we
want.
That's exactly what we want, and you shouldn't have to change anything.
So let's nip this recession conversation in the bud. And I'm sorry to upset people that love drama, because we don't. We like plans and planning for the future and probabilities. You're saying, Brian, if I'm hearing you correctly, don't worry about it.
That's what I'm saying.
Okay, good. I heard you correctly.
I'm afraid that some people will say, well, you're insensitive. I'm afraid that maybe people will say that. And what I'm saying is it really shouldn't change your investment approach.
No, it's not insensitive, because when there's drama and fear in people's minds, that's when they make dumb mistakes that destroy their capital.
Good point.
And if we can keep people calm, which they should be, with that drama that they're going to hear and are hearing, then we prevent them from making the bad mistakes.
Stick to their plan.
Yep.
Have a plan and stick to it.
Yep.
And that's exactly what we're doing.
So, have peace, my friends. All right, last thing I want to talk to you about. We hear in the financial world, you got to buy growth stocks, or value's going to make a comeback, or you know what, you should focus on income stocks. And that drives me nuts. But I want to hear from you. Growth versus value versus income. Which is best?
So let me break this up a little bit.
All right.
Growth value first.
Okay.
There's no such thing as growth stocks. I mean, there are, people categorize them, but I think it's the wrong way to look at a company or a business, or how to value a business. The definition of a value stock is typically a business that historically sells at a lower multiple of earnings, or a lower valuation based on the earnings of that company. So a lower multiple in today's market, that probably means somewhere in the teens, like a 15 multiple, or even a 12 multiple. We own some bank stocks that are selling at 12 multiples. That would be considered a value stock, a traditional value stock.
So can they not grow?
Say that again.
So can that value stock has no growth behind it? Is that what they're saying?
That's where the problem comes.
Yes, it is.
And then you have growth stocks, who are by definition companies that growing their earnings at a higher rate. Those are growth stocks. Some of the more well-known companies, Apple, Google, some of those are what we call
Zooms of the world the last couple of years.
Yeah, those are growth stocks. We don't look at stocks like that, in that lens. We're looking at the growth and the value of that business, or looking at the growth of that business and using that as part of our calculation on the value of that business, what the business is worth. So growth is part of the calculation. We don't say, oh, let's go out and buy some value stocks. Oh, we should go buy some growth stocks because they're popular. That's not the right way to look at it. So that's growth and value. I think it's the wrong way to look at stocks. And people are saying, okay, well, I'm going to go buy value because it's popular right now, or I'm going to buy growth, or growth and value. Wrong. I think it's wrong.
We look at it as growth at a reasonable price.
Right. And growth is part of the calculation of value. When we calculate the value of a business,
I love that.
Growth is part of the calculation, when we calculate value. If you got a company growing at 20+% a year, growing earnings at 20+% a year, you need to take that into consideration when you value that business, and that's what we do. As opposed to if you got a company that might be growing at a lower rate, let's say 6 or 7% earnings growth historically, you need to look at that. You need to account for that as well.
It could be a good value investment at a higher multiple, right? Because it's growing so much.
I think right now, some of our what most people would define as growth stocks are actually really value stocks. They're very valuable. They're selling at discounts to their intrinsic value. But most people would say they would not say they're value stocks. They're growth stocks, but they're selling at value prices.
So you're saying the whole growth and value debate, ignore it?
I believe you should ignore it. That's the wrong way to look at stocks. So then income.
Right. I like where we're going today. Ignore the recession. Don't ignore it, but don't worry about it.
Don't worry about it.
And ignore growth and value. We are clearing the deck for people today. Income.
Yeah, don't have a strategy say, okay, I'm going to go buy growth stocks, because it's supposedly popular.
That's what I'm hearing in the news.
That's what you're hearing, or that's what I heard today.
Yeah.
I'm going back into growth names, or I'm going back into. In fact, growth names have had a rebound, so now it's the popular. Where 3 weeks ago is value stocks. Oh yeah, I'm going into value. That's just the wrong way to do it. Wrong.
Okay, income. I want a dividend-paying stock, Brian.
So income, I love dividends. Nothing against them. Talked to a client today about it. He asked me about dividends and what do you think about it? Wants to invest in dividends. I don't know. I get this question or request or
a lot.
Oh, I want to buy dividend stocks.
Yep.
And I think a lot of people think that if they own dividends, that must mean that this company is stronger financially, more secure financially, because they're paying dividends.
Which is not true.
It can be, but it's not. That's not how you define a good, solid company.
Yeah. Or they look at income as being the cash flow that they need to live in retirement, right? I need those stocks to be creating income so I can live in retirement.
So now I'm going to come back to value and growth, or at least value.
Oh boy.
You should focus on value, not the dividend.
What do you mean?
Meaning, identify businesses that are selling at a discount to their intrinsic value, and if they pay a dividend, great. But don't focus on the dividend. What that does is it causes people to overpay for income or for dividends. It happens all the time.
All the time.
We were talking earlier, AT&T, great example.
Yep. They cut the knees out of the dividend. People that bought that stock for a dividend in the last 5 years,
There's so many.
they lost half of it.
So many people have bought AT&T and not just AT&T, but companies that have high dividend yields, chasing the dividend, and then they look at the returns 3 or 4 years later and like, that's been terrible.
All right, let's talk about returns.
So don't chase income. That's just the wrong way to do it.
So there's a Dividend Aristocrat ETF, SDY, and I looked at 5 years of returns. Okay, if you would have invested $10,000 into that dividend paying ETF 5 years ago, you would have $14,750. So a return of 48% in 5 years. Hey, 48%?
It's actually not that good.
Well, let's judge it compared to the S&P 500.
That's got to be like that was over how many years?
5.
Oh, okay. That's about 7 or 8% a year, probably.
So 5 years, S&P 500. So not focusing on the dividend, just buying the index. Your 10,000 becomes almost 20,000, 19,610, which is a return of 96%. So what? And by the way, that's still giving you a dividend at 1.2%. It's just kind of like icing on top of the cake.
And probably the rough estimate annual return on that S&P is probably around 15, and half of that in the dividend fund you just mentioned, probably 6 or 7%. I mean, neither of them are terrible. I mean, obviously the S&P is much better.
Well, it's the last 5 years too.
Right, but of course
What would you rather have?
Well, of course you want the S&P, and the S&P pays a dividend. But if you're not, stop focusing on just the dividend.
If I need money to live off of in retirement, and the Amazons, the Apples of the world, those aren't recommendations, examples. They've outperformed the S&P over the last 5 years. Amazon doesn't pay a dividend. Can I still use that for retirement income?
You can, and we do it all the time.
Yeah.
We do it all the time. For example, we may have a client that's, let's just throw a number. They want $5,000 a month out of their investment account, and we send it to their checking account.
That's cash flow.
But what we do is once or twice a year, we'll go out and sell some stocks, replenish when it's a good time, and put money in their future income needs account or in their money market account. And we just replenish those funds so they have 2 years of needs, and that's coming from both dividends and from long-term capital gains.
Growth. So here's kind of the mantra at Iron Gate, right? It's not income for people in retirement. It's the potential to grow their income in retirement. And what I mean by that is typically you take 4 to 5% out of your investments to live off of. That's the normal formula. Mm-hmm. Okay, so if you take 4% out of that 14,000 versus 4% out of 20,000, which one is the better income?
Yeah, the higher one.
So it's the focus not on dividend paying stocks, which is, again, an extra benefit, but it's the idea of growing your income, which comes by growing your account.
By growing your portfolio. Really, that should be the goal, not just, hey, I want dividend income, but the goal, like you said, should be growing your portfolio so that it will generate more revenue or gains for you over the long term. Whether it comes from dividends or capital gains, it doesn't really.
So at age 65, or should I say at age 75, you can take more out of your investment account, which you need to because of inflation, than you could at 65 because your portfolio's grown.
Right. If you have a $2 million account versus a $1 million account, which one's going to provide you more income or in the future?
So the focus of growth versus income versus value is completely oversold. And it's just a dumb conversation in the media.
Yeah. We're trying to identify value, not necessarily a dividend, a dividend interest rate, or going from value to growth. But not in our value, the way we're looking at it is not traditional value investing. We're trying to identify great value situations and opportunities that will create your portfolio to grow. If you buy it at a good price, then you're 5 and 10 years down the road, your portfolio will grow, and that will create
More income. And all the while, Jed and Brian are still putting gas in the gas tank.
And creating opportunities for us
To grow it even more. Yep. All right. So we've talked about the current market returns and how great an opportunity when the market's down, send money. We can put it to work. That's a great time to do it. Talk about a recession, inverted yield curve, and growth value versus income.
Yep.
That's a podcast, man.
That is. Covered a lot of topics.
And I hope it helps people relax a little bit more and not focus it. Again, what's that great song? Accentuate the positive, eliminate the negative. Don't mess with Mr. In Between. I'm not going to sing it. That's what we're trying to do. Eliminate the negative. So relax. We got a plan for you.
Let me say one thing.
Yeah, please.
Advertisement.
Oh.
I was talking to Brian last week.
Okay.
Jed's buddy.
Mm-hmm.
And he asked me a question about how we do things, and he's been a client for several years. And I says, Brian, write that down and send it to me or email me. So what I'm saying is, if those people who are listening, if you have a question, send it to Brett, send it to me, send it to Katie, and we can talk about it in one of our future podcasts. Yeah.
Love it.
Yeah.
Love that idea. Yeah, send them in.
Okay.
Love to talk about it. All right, brother. Good luck in your bracket.
Yeah. Thank you.
Until next time. Bye-bye.